Chapter: Business Finance, Needs and Sources. Key Objectives.
Hello everybody. Today we are going to learn about one of the most crucial topics in business studies, which is sources of finance, its needs and what are the various sources available. Do you know that approximately 86% of the new ventures fail majorly because of the cash flow problems or lack of sources of finance? With this chapter, you will be able to answer the basic fundamental questions: why businesses need finance? Second, what are the various types of internal sources of finance and external sources of finance? Third, what are the long-term and the short-term sources of finance? And last but not the least, what is the best method to select the sources of finance which is most suitable to the business at this point in time? You should be able to solve basic fundamental financial problems with this chapter. Now we move on to the very next topic.
Why businesses needs finance?
Why businesses need finance? Why businesses need finance? One of the major crucial point is to start the business. Startup capital is needed for any business who wants to begin their activity. For buying maybe a non-current asset that they need, to rent a space, to pay for basic raw materials that they need for manufacturing. Any business who starts will need a startup capital. For that, they need finance. The second reason is that they will need finance for expansion. Once the business has started and is doing well, you would want to expand the activities, right? The business wants to grow. For the growth, they will need certain amount of money. That money is very crucial because you are not going to be able to use the already invested funds in the business. Why? Because either they are stuck in any of the non-current assets or they are in the working capital requirement. That money cannot be used, which is why an additional source of finance is needed for expansion. Third, the business will need money in order for the daily activities, which is working capital requirement. Now, what is a working capital? Businesses would need to invest in inventories. They will have trade receivables, they will have trade payables. So in order to have all these business running, they will have to pay for wages. In order to run the business, they will need this finance. That is called as a working capital requirement. Remember, this working capital is one of the most crucial money requirement for any business. After the startup, it is a daily operation that keeps the business running and profitable. If there is a lack of finance for it, a lot of businesses do fail. Cash flow problems do arise, and which is why businesses are going to need working capital time and again. That could be one of the major reasons. Last but not the least, businesses need finances for many other reasons like research and development. Once a business is established, they might think of maybe coming up with a new technology, maybe investing in a new technology. They want to find something better or how they can improve the functions of the business, and for which mostly the pharmaceutical companies are the major one who invest a lot of funds in the research and development. That funds are very crucial because they can be stuck in the business for a longer duration. And if the development is not successful, it can also become a sunk cost, which is why finance is very important. Usually long-term sources of finance are used. Another reason is for sponsoring an advertising campaign. Businesses do advertising on a daily basis. However, when they are doing a major product launch, they will come up with a huge advertising expense in order to make success or make people aware about the product that they have launched, and which is why they will need a huge source of fund.
Types of sources of finance.
Now let's move on to the different types of sources of finance that are available. There are two types of sources of finance: internal and external. First, let us understand what are internal sources of finance. Internal sources of finance are the finances that are generated from within the business. These are not procured or taken from outside, which is why we call them internal sources of finance. Now, there are four types of internal sources of finance that are available. The first one is owner's funds. Second, retained profits. Third, sale of assets. And last but not the least, sale of inventory. Let us look at each one of them one after the other. Owner's funds or owner's savings are type of sources of finance which the owner can bring in the business. Now, the best advantage of this type of source of finance is there is no additional cost to it. For instance, if you are borrowing a loan or taking a debt, you have to end up paying interest. Now, that is a cost of borrowing or cost of capital. This increases the expenses of the business and which is not viable. Owner's funds is something which is interest free, and so it is far more easier to procure it. However, many times this type of source of finance is not available. Maybe the owner has already invested most of his funds or savings already in the business and does not have any additional source. So sometimes it is a problem that they might not be available for the businesses. Also, owner's funds are a type of source of finance which is available for two types. One is sole trader and the other one is partnership. These are the two organizations that can use owner's savings in order to finance their funding. The second one is retained profit. Now, retained profit are something that the businesses reinvest in the business. For instance, if this year a business has earned $1 lakh as net profit, out of this they will pay off 30,000 as dividend to the shareholders and remaining 70,000 is reinvested in the business for future investments, expansion or working capital requirement. This retained profit can again have an advantage of there is no cost of borrowing, there is no interest cost, so it is available free of cost, not increasing any expenditure for the business, and so the profit margins can be maintained. However, retained profits may not be sufficient to fund the expansion or any other type of money that is required. Another thing is this type of a source of finance is not available. Mind you, this is a very basic error that kids make or students make when writing examination. They write this as a source of fund for a newly started business. Obviously, a newly started business will not have earned any profits to be able to finance the future of the business. So make sure that you do not make an error. I have marked this in red, asterisk it in red majorly because this is where common errors are found. Third one is sale of asset. Now, what do you mean by sale of asset? Remember, again, this is a type of source of finance which is not available for new businesses, freshly started businesses, majorly because they will not have any asset which is lying idle or is redundant. Mostly the sale of asset any businesses is using as a source of finance because they are having some unused or redundant assets which are no longer put to use in the business. Now, this is again one of the major sources of finance for those companies which are capital intensive in nature, which means that they have a lot of investment, they have done physical capital investments a lot, which is why they have so many idle or maybe scrapped off assets which are lying around. It is ideal to actually offload them so that the business can make use of those idle lying assets and put them into a more productive use. Now, you do not have, when you sell any redundant or unused asset, you do not have to pay any additional interest, which is a savior. However, this type of source of finance is not available for newly started businesses. Also, sometimes the assets that are there may not be idle enough to sell, or they may bring in only a minuscule amount of money, which is not ideal for expansion activity or replacing the old asset with a new one. So one must understand that how much money is going to be generated, that is going to be very important. Last but not the least, the internal source of finance is selling of inventory. Now, businesses is already selling off a lot of goods, right? Now, those inventories may be lying in the godown. What business can do or the entrepreneur can do is they can work on offloading huge amount of inventory together. This will raise finance for them and which can be used for funding the operations. Usually, selling of inventories will not bring in a lot of capital. However, in order to meet any short-term cash flow requirement or short-term cash flow problems, this is an ideal situation. Number one, it saves storage cost, and the second, insurance cost is also saved. Third, you do not have to raise any kind of a interest expense. This is ideal. Plus, you are selling off, so your sales revenue is also going up. However, sometimes you may have to, in order to offload a huge amount of inventory, you may have to give huge amount of discounts. That can maybe hit a margin for you, but that is all right. In order to meet the short-term cash flow requirements, this is an ideal situation. Now, let's move on to the external sources of finance. Now, what are external sources of finance? External sources of finance are those finances that the business can access from outside the organization, which means you can go to investment bankers or bank, you can go to various financial institutions for help in order to raise funds. Now, the very first external source of finance is bank loan. Now, bank loans are of two types, majorly short-term and long-term. Always remember, short-term sources of finance will be used majorly to fund working capital requirements of the business. You cannot buy assets, which is a long-term use in the business. Always remember to match the time required, the finance is needed to fund a long-term capital expenditure, then you will have to find a long-term source of finance for it. So remember, bank loans which are short-term are used to meet the short-term cash flow requirements or working capital requirements of the business. Similarly, we have bank loans which are long-term. Long-term bank loans are ideal for funding the long-term expansion activities. Maybe when the business is even starting up and the entrepreneur does not have any funding, they can approach the bank and raise finance from there in form of debt. That is ideal, but for that they will have to submit the entire business plan and will have to approach the bank in a certain manner. The business planning is a chapter that we have covered earlier. You can go through that. Next one is bank overdraft. Bank overdraft is a facility which is a short-term facility. Remember, this facility is only given to business account holders. It is not available for anybody who has a saving account. Business accounts are usually called as current account, and this is a special facility which is offered by the bank only to the business account holders. What you can do is you can overdraw the account over and above the amount of balance that is available. What I mean by this is, let's assume that you have gone to the bank and said that I want an overdraft facility. Now bank will they will ask you for certain amount of collateral. They will value the collateral and they will say, okay, we are able to offer you approximately $200,000 worth of overdraft facility, which means if my current account balance is $1 lakh, I can add an additional $2 lakh worth of, so I can issue up to $3 lakh, $300,000 worth of check to any payment. Now remember, what this means is that, number one, this can be only used for short-term cash requirement, which is working capital, some immediate funding requirements that is needed, that can be fulfilled through bank overdraft. Second, there is a disadvantage to this is usually the bank overdraft interest rates are much higher than the normal bank loans also. Third, it is available to specific account holders who can offer collateral. Collateral is nothing but something that you can give to the bank as a safety net to fall. What if the business is unable to pay off the bank overdraft? Then the bank can sell off that particular collateral or an asset and then recover the funds. So collateral, whenever when the business gives collateral, they will end up having no other safety net to rely on. For example, if in the future they want to raise any bank loan, they will have to give collateral, right? So if they have already given the collateral in form of bank overdraft, they will not have that asset available to give as collateral for a long-term bank loan. So there are pros and cons to each one of them. Third one is issuance of share. Mind you, issuance of shares is available as a source of finance only to limited companies, that is the public limited companies and private limited companies. Also, this is to raise huge amount of capital, right? So if the business is planning to maybe expand in various activities or start a mass production of some goods, then this is an ideal source of finance that they should use. However, remember that here the major issue is that the administrative cost, or in order to issuance of shares, there's a huge amount of administrative requirements, legal requirements and other kind of a cost which is raised. Underwriters' fees needs to be paid, investment bankers' fees needs to be paid, which is a huge amount of cost, right? So issuance of shares is something that comes with a huge amount of cost, and so it is only ideal when a business is raising a huge amount of capital which is going to be used as expansion. Also, like I said, this option is only available for two types of organization. One is private company and public limited company. Third, issuance of debentures. Again, this is a long-term source of finance. However, unlike the shares, issuance of shares, which is like raising equity or raising capital, debentures is raising debt from general public. This option is only and only available to publicly listed companies. And again, in order to issue debentures, there is a huge amount of administrative, legal and underwriters' fees cost which is raised. Ideal again for any expansion activities, but only when the business is going to raise huge amount of capital. This source of finance is not ideal for anybody who is a smaller public limited company. Only and only when they are raising huge amount of capital do they need to raise debentures from general public. Third one is next one is trade creditors. Trade creditors are one of the short-term sources of finance. Again, here you do not have to incur any expenses, but the major major reason to get a trade creditor is when you maintain good amount of relationship with the person supplying you raw materials or the goods that you are trading. You can basically exchange longer credit periods or negotiate longer credit periods with the trade creditors. This is like a free source of finance for your businesses. For instance, you bought a raw material for $1 lakh. However, you need to pay not now but only after 1.5 months. Imagine if you can increase the amount of credit period that they have given to you from 1.5 months to 2 months. You are getting $1 lakh freely to use in the business, and that can save a lot of cost. Third one is factoring of debts. Now this is a different type of a finance which you must have not heard at all before. Now what is this is, a business will have debtors. They will have invoices of those debtors. Now debtors are somebody that pays you at a future date, right? Now this money is there with the business, but it is only going to be received in a future date. Because of this problem, the current situation, maybe a business is undergoing some cash flow problem, or they have to meet some short-term obligation, funding obligation. Now what they will do is they can take those invoices to the bank and ask them to pay them immediately in cash for those invoices, and in the future once they receive that amount they will pay back to the bank. So what does a bank do? They charge a minuscule or a nominal amount of fees for this kind of a service and immediately give funds to the businesses. So remember, trade creditors, although you're offering them credit period, but they are not for waste. You can possibly raise finance by factoring of debt with the bank. Next one is crowdfunding. Now crowdfunding is something new. It is not an old concept or a conventional concept. What is crowdfunding? Crowdfunding is when the business uses an e-commerce platform or an electronic internet website in order to raise finance. There are special crowdfunding companies who basically checks the background of the businesses. They upload all the legitimate business documents online and ask for funding for the business. Here, that crowdfunding website will charge a minuscule amount of fees from overall funding that is raised. Here, in smaller denominations, people can invest funds in the company. Now this is, but huge amount of funding can be raised from this. However, remember this, that since not many countries or not many places do offer this crowdfunding options. So there are certain countries where crowdfunding for businesses is still not available. So maybe new and maybe not available. Next one is microfinance. Now microfinance is one of the most developed topic today. There are special types of banks that give loans to smaller businesses in smaller denominations. In the sense, imagine if one person wants to be a tailor and wants to open a tailoring workshop. Now at these kind of businesses will not need a huge amount of an investment or funding, which is why what happens is certain banks, the commercial banks, are very reluctant to lend them money, which is where microfinance banks comes into picture. These types of smaller startups are given loans through microfinance banks. However, microfinance, remember that they are going to charge interest, so the new businesses may not be able to pay the huge amount of interest that the microfinance banks are charging. And second, the business will have to prove to them that their business is really viable and is sustainable in the long term. So this is available. Long-term finance is available from by microfinance banks to smaller businesses. Last but not the least, private equity firms. Now even this is a new concept that has come in. Private equity funds are these kind of a huge high net worth individuals that come together and fund operations of the businesses. Usually they look at investment worthy organizations or businesses in which at the initial stages, when the business is just coming up with the ideas, also when the business has just started production or at a very small scale, they will invest in such kind of businesses for scaling the operations. Let's look at examples like Zomato. Now this is a food delivery app that got funding from private equity firm, and now they are publicly listed companies. Now private equity firms, when they are funding the operations, always remember that they will want to have an exit at certain point in time. Now that exit can be crucial. Why? Because their funding will have to be then replaced with the full amount of investment. So what happens is, in between, the business may have to go public even though they are not willing to at that point in time. So the private equity firm, although that's a lucrative option, but it is not for all types of businesses. One must understand this, that this option is available only for majorly more scalable businesses. You must have seen that in Shark Tank or Dragon's Den, that how these businesses function and how they get funding from the high net worth individuals. This is it from the external and internal source of finance and how they are bifurcated in short term and long term. Now let's move on to the next part. How to select out of all of these sources of finance which are available, how to select the best source of finance based on the current situation, and what are the factors that affect what source of finance to use.
Selecting appropriate source of finance.
Since we have looked at the various types of sources of finance that are available, now let's look at how to best select which source of finance is appropriate in the current situation. Now, what are the factors that affect them? The very first is amount needed. Always remember, a business can need a smaller amount of finance or maybe a huge amount of finance. Usually, smaller amount of funds are needed to sponsor the working capital or fund the working capital of the business, or short-term cash obligations that are due. Right? In such a scenario, you must look at examples like owner savings, short-term bank loans, bank overdraft, factoring of debts. These are the best sources of finance which are available. If the business wants to fund any long-term funding requirement, for instance, they want to buy any fixed asset or a non-current asset, then what they need to look at long-term bank loans, etc. Long-term bank loans are there, owner savings are there, selling of a redundant asset is there. All these factors will raise long-term sources of finance, right? The next one is time for which the funds are needed. If the funds are needed, always match the funds. Like I said initially, always match the fund with the time needed. Short-term sources of finance will be used to fund the short-term funding requirement, whereas long-term sources of finance will be used to fund the long-term funding requirement. For example, if I want to pay off the creditors, then I will need bank overdraft or any other short-term source of finance like short-term bank loans in order to pay off those creditors. Whereas if I'm buying or investing into R&D, I'll need long-term sources of finance. Maybe in such a situation, issuance of shares or maybe using the retained profit of the business, which is in a huge amount, that can be used in order to fund. Next one is gearing of the business. Now let's first understand what is a gearing. Gearing ratio is nothing but the proportion of the business that is owned by the outsiders. For instance, the business has a total capital of 1 million, out of which 50% is owned by maybe a bank loan or issuance of debentures. In such a scenario, one can say that the business is highly geared. Why? Because outsiders have invested huge amount of funds in the business. In such a situation, what happens is when the gearing is high, the risk is high, the interest payments are high. So what happens is, maybe if the business is not able to generate sufficient profits, still they will have to pay off the debt servicing, that is, interest payments will have to be paid from anywhere. In such a scenario, what happens is this can put a lot of pressure on the cash flow requirements, and so many businesses do fail. So gearing of the business is very important. If your business is already highly geared, then external sources of finance or borrowing more funds will not be a lucrative option. In such a scenario, the business must look at internal sources of finances where their cost is not increasing, the gearing is not increasing, and also the control remains with the business. Because already if the outsiders have invested so much of funds, they might start interfering with the daily operations as to how to run a business. So gearing of the business is going to be one of the crucial points in selecting what source of finance to choose. Next one is the type of business organization. This is something that we have already learned, that a sole trader will have limited options from where they can raise funds. Owner savings is one. Maybe if the business is old, they might have retained profits, unused assets are there, but they will never have the option of issuing shares or debentures, because that is the option only legally available to the private limited companies and the public limited companies, as the case may be. Next is control of the business. Now, what do you mean by control of the business? A lot of organizations, owners or the promoters of the business who had initially begun the businesses should maintain or have certain amount of control on the business activity. Only then will the business run smoothly. If the outsiders, if they lend more amount of funds to the business, if you're raising funds from a bank loan, what usually happens is the bank will have somebody from their organizations put on the board of directorship in such businesses. In such a situation, what may happen is they will start interfering and leaking information which is internal and secure to an outside world, which can be risky for the business, and their ideas can get lost. So control of the business means nothing but where the main owners of the business have complete control over the business activity, and the outsiders do not interfere with the daily operations. This is going to be crucial. So each of these factors are going to play a fundamental role in selecting which source of finance to use when. And businesses that choose them wisely are going to be successful. Otherwise, there can be a lot of bottleneck situations that the businesses can face. What do I mean by that is, although they might have a lot of funds running in the business, yet they will not be able to meet their short-term cash flow requirement. So planning is crucial part for the business to run smoothly with sufficient sources of finance. This ends the chapter here. I hope this was insightful, and we will now meet in the next chapter, which is cash flow management.
Thank you for watching. Kindly like, share and subscribe for more lectures.